Financial news has never been more abundant, more immediate, or more confusing than it is today. Every hour brings breaking headlines, urgent alerts, confident predictions, and dramatic narratives competing for attention. For most investors, this constant stream does not create clarity. It creates tension. The paradox is that while access to information has increased dramatically, the ability to extract signal from noise has quietly declined. Understanding financial news is no longer about consuming more of it, but about knowing precisely what deserves attention and what can be safely ignored. The first thing to recognize is that financial news is not designed primarily to make you a better investor. It is designed to keep you engaged. Headlines are optimized for emotion, not insight. Words like crash surge panic and record-breaking are chosen because they trigger instinctive reactions. This framing pushes readers toward urgency, even when the underlying information is incremental or irrelevant to long-term outcomes. Smart investing begins with accepting this incentive structure, because once you see it clearly, you stop mistaking excitement for importance. What truly matters in financial news is not events, but changes in expectations. Markets move not because something happened, but because what happened was different from what was already priced in. A strong earnings report can push a stock down if expectations were even higher. A weak economic number can lift markets if it reduces the likelihood of tighter policy. Reading news without understanding expectations is like watching the scoreboard without knowing the rules of the game. The surface reaction makes little sense until you ask, compared to what? Macroeconomic news often dominates headlines, yet it is also the most misunderstood. Inflation data, interest rate decisions, employment reports, and GDP figures are treated as definitive verdicts on the future. In reality, they are snapshots, with margins of error, revisions, and lagging effects. What matters is not the number itself, but the trend, the context, and how it alters policy paths or capital flows. Overreacting to a single data point is one of the most common ways investors allow news to hijack strategy. Corporate news requires a similar filter. Announcements about earnings, acquisitions, product launches, or management changes sound decisive, but their long-term impact is often uncertain. A surprise quarter rarely changes a durable competitive advantage. A bold acquisition may look transformative, while quietly increasing leverage and integration risk. The investor's task is to separate information that affects long-term cash flows from information that merely explains short-term price movement. Most headlines fall into the second category, even though they are presented as if they belong to the first. Another critical distinction lies between narrative and evidence. Financial news often constructs coherent stories after the fact explaining why markets moved in a certain direction. These stories feel satisfying because they impose order on randomness. The danger is that they encourage false confidence. Markets move for many reasons simultaneously, many of which are unknowable in real time. Treating tidy explanations as causal truth trains investors to believe that the future is more predictable than it actually is. This belief leads to overtrading, not better decisions. The most valuable financial news tends to be the least dramatic. Changes in regulation, shifts in capital allocation, subtle adjustments in guidance, or alterations in incentive structures often matter more than headline-grabbing events. These developments rarely demand immediate action, but they shape the environment in which businesses operate over years. Paying attention to them requires patience and curiosity, rather than adrenaline. Investors who cultivate this habit slowly build an informational edge that is invisible to those chasing urgency. Equally important is understanding what financial news cannot tell you. It cannot define your risk tolerance. It cannot determine your time horizon. It cannot replace a coherent plan. News operates on a time frame measured in minutes and days, while successful investing operates on a time frame measured in years. When these horizons collide, the shorter one usually wins emotionally, even if it loses financially. Protecting yourself from this mismatch is one of the most important skills an investor can develop. Decoding financial news, then, is less about intelligence and more about discipline. It requires deciding in advance which types of information are relevant to your strategy and which are distractions. It requires the humility to accept that most news does not require action. And it requires the confidence to remain still when others feel compelled to move. These traits do not come naturally, especially in environments designed to provoke reaction, as the flow of information continues to accelerate. The gap between informed investors and reactive investors will widen, not because some people know more, but because some people filter better, and learning how to build that filter, how to recognize which signals deserve attention and which exist purely to capture emotion, is where the real work begins. Because without that filter, financial news stops being a tool and becomes a source of confusion and unforced errors. Which brings us directly to the next part, where we need to examine how to build a practical filter for financial news. Because without a filter, even intelligent investors slowly drift into reactive behavior without realizing it. The first step is defining relevance. News is only useful if it can plausibly change a long-term decision. Before reacting to any headline, ask a simple question. Does this information alter the long-term cash flows, risk profile, or competitive position of the asset? Or does it merely explain why the price moved today? Most news fails this test. Learning to dismiss it quickly is not ignorance, it is focus. The second step is separating direction from magnitude. Financial news often gets the direction right, but exaggerates the impact. Yes, interest rates matter, regulations matter, earnings matter, but rarely in the extreme way headlines imply. Markets are adaptive systems. By the time something is news, many participants have already positioned for it. Smart investors pay less attention to whether something is good or bad, and more attention to whether it meaningfully changes the range of possible outcomes over time. Another essential habit is delaying interpretation. Immediate reactions are usually emotional reactions. Waiting does not reduce insight, it improves it. Let prices move. Let commentary settle. Let more information emerge. Many headlines that feel urgent in the morning are irrelevant by the end of the week. Time is an underrated analytical tool. It reveals which news has lasting consequences and which simply satisfies the market's appetite for drama. Context is the next layer. A piece of news rarely stands alone. Economic data must be viewed against trends, not single prints. Corporate announcements must be evaluated relative to valuation balance sheet, strength, and industry structure. Without context, facts mislead. With context, even negative news can be constructive. Investors who train themselves to ask relative to what avoid the trap of taking headlines at face value. It is also critical to recognize the difference between information and opinion. Financial media blends the two seamlessly. Predictions, forecasts, and confident commentary are presented alongside facts, often without clear distinction. Treating opinions as data leads to overconfidence. Smart investors respect uncertainty. They use news to update probabilities, not to seek certainty. The goal is not to know what will happen next, but to avoid being surprised by what could happen. Perhaps the most powerful filter is alignment with process. If a piece of news does not map to a predefined action in the investment process, it should not trigger action. Rebalancing rules, thesis checkpoints, and risk limits create boundaries that protect against impulsive decisions. News then becomes input, not instruction. This shift alone dramatically improves consistency because it restores control to the investor rather than surrendering it to the information flow. Finally, understanding financial news requires accepting what cannot be known. Markets are complex, adaptive, and influenced by countless variables interacting simultaneously. News provides fragments, not the full picture. Investors who demand certainty from headlines end up trading confidence for accuracy. Those who accept ambiguity are better equipped to remain patient and rational when others are not. In the end, decoding financial news is not about becoming faster or smarter than everyone else. It is about becoming harder to manipulate emotionally. The investors who succeed over time are not those who react first, but those who react least, and only when reaction is justified by changes that truly matter. Financial news will always be loud. The skill lies in deciding when to listen and when to let the noise pass. If this perspective helped you rethink how you consume financial news, consider subscribing to stay with these long-form discussions that emphasize clarity over urgency, and leave a comment sharing what types of headlines you now plan to ignore, because learning what not to pay attention to is often the most profitable insight of all.